the main subject of what we're talking about right now is this new tax bill that was passed. That, you know, when this title first came out, we thought, oh, well, that's President Trump being President Trump. Because that was a little bit of a lighthearted, silly title, but lo and behold, it stuck. That's what they called it. Due to time constraints, it's not like we're going to be able to go on about all of it and give a lot of details, which is also fine because that would be super boring and may or may not apply to the people in this room. So what we tried to do is kind of narrow it down to talk about the most common things that are going to affect just regular folks like us. One thing I wanted to point out, we're going to talk about some things and we're going to use the word permanent. Some of these things were made permanent. We're going to use that term really loosely, permanent and temporary. In terms of today's discussion, permanent means that they've set it and we know it's going to stay that way until they change it. Okay? As opposed to if we call something temporary today, it means that it's there and we know what's going to end. Like in the bill, it says this is going to end or sunset on this in this year. So
they make it permanent that year.
yeah, so let's just make clear that you know Congress, that nothing's permanent, but we're going to use that term because we at least know that it's not going to change until they change it.
It's not going to change automatically.
Yes, yep. So to clear up that vernacular, lower tax rates. So this is the 2017 tax law. And this tax law lowered the tax rates kind of across the board. So just as an example, it used to be the 15% bracket is now 12, and so on and so forth down the line. And then the highest tax bracket before this was 39.6. I've always been fascinated with how they came up with 39 and needed to put a 0.6. Like where that came from, I have no idea. But for a really long time, that was the maximum tax rate. With this new bill, we make these tax rates permanent because, again, they were set to just go back to 2017. And then as part of these tax brackets, as you know, there's just a certain amount of income that you can have and remain in this tax bracket. And so the amounts, the income amounts that apply to each one of these brackets is also increased and then set to increase with inflation. So we didn't put a chart up with all those numbers because sometimes that gets a little too busy and it doesn't make sense. But just know that those income thresholds are set to just increase a little bit each year based on inflation. I don't have them all completely memorized, but I know that the 12% bracket ends in the neighborhood of taxable income of $90,000
Married filing joint.
on a married filing joint return. That's the one that I'm always looking at usually. So you've got to get, in order to get to this point, it's over $400,000 of taxable income. And that terminology, taxable income, is important because that is figured after all of your standard or itemized deductions. So it's not your gross income, but it's your income, your gross income minus the standard or itemized deductions that you...
Or other deductions that we'll be talking
Yeah.
about.
Okay, so this one, this new deduction for seniors, there's been a lot of talk about Social Security being taxed and how maybe it shouldn't be taxed. It was probably talked about in the campaign about eliminating the tax on Social Security. Now, for a really long time, I would say to people like, well, they're taxing your Social Security and they shouldn't. And I would say because you've already paid tax on that money when they withheld it. And that's true for half of it. When you work for somebody and they withhold it from you and send that to the IRS, your employer, the employer then matches it. So you actually haven't paid tax on half of it. The other half you haven't paid tax on. So for years and years, the most that they would tax your Social Security was 50% of it. That makes sense because of the fact that you really only paid tax on half of what went into it.
And the employer didn't have to pay tax because it was a deduction to him.
Yes, right, exactly. So I've changed my my approach to that just a little bit, and in all fairness, it's like, well, okay, then maybe 50% should be taxable. But right now, the maximum that they can tax is 85%. So instead of doing any of that and making Social Security not taxable, they threw in this for people 65 or older. A married filing joint couple has an additional deduction of $12,000, and if you're single or married filing separate, it's $6,000. So that was the answer. That was kind of the solution to that campaign promise.
Plus you don't pay taxes on your first $24,000, but that's something different.
Yes, so that what you're talking about there is the standard deduction. And again, I don't have the exact dollar amount, but in rough terms, a married filing joint couple, that's around $30,000. So this is in addition to that. And
you don't have to itemize to get this. So normally
Yeah.
you either take the standard 30,000 or you take your itemized deductions. This is in addition to either of those options.
so if nothing else, a married couple, you're eliminating the tax on $12,000 of, we can say your Social Security income, but it's not tied to that. It's just, say you're over 65 and you're like truly retired. You're not working, you're just drawing on maybe a 401k or an IRA, and then you've got your Social Security benefits. What this does is after they've figured your tax on your pension or 401k, and then assuming that your income is sufficient that 85% of your Social Security is also taxable, you add those numbers up to come up with your adjusted gross income. So that what that term means is it's before your standard or itemized.
Okay. And then
So we get that gross income figure. Then this terminology above the line means something to us accountants, and to the rest, like, it might mean something to you, but what this means is this deduction is going to come out before we even consider your standard deduction. And so then it lowers your income. Then you look at your standard or itemized, and that lowers your income further, and then that's what your tax is calculated on after all those deductions. So in a nutshell, this is just an additional free deduction that's coming out of thin air if you're 65 or older.
There's income limitations as well. So you have to be within that income bracket of $150,000 for married filing jointly, or $75,000 if you're filing single. It gets completely phased out at $175,000 if you're single, or $250,000 if you're married filing jointly.
So this is one of those things, this threshold here, that I like to point out, that yes, once your income gets above a certain level, this gets eliminated. So you'll hear the talking heads on TV talk about how the wealthy get all the tax breaks. I just want to reiterate to you how inaccurate it is to say that, how utterly inaccurate it is, because
they pay all the taxes.
based on my 30 years experience, this is just one example of once your income gets to a certain level, they start eliminating the deductions that are available to everyone else. So the opposite is actually true. The wealthy, meaning, and when I say wealthy, I guess I'm saying people with high incomes. Everybody has their own definition of what wealthy means, but we'll just say the higher income population loses tax breaks. They don't get them. And if the talking heads were to tell me, if I could sit down in a room and say, okay, these loopholes that you talk about that only the wealthy get, tell me what they are, because I have some clients that could really use some. But I don't know what they are. I've been doing it for 30 years, and don't pretend to know everything, so I could learn something, and maybe the people that are touting that could tell me what they are, and then I could utilize them in my practice to help out my wealthy clients to save a little tax. Because they're already...
Because they make you think, oh, the rich pay nothing, and it's so stupid.
If 37% federal and 5% state, that's 42%. If paying 42% cents on every dollar you make is like,
It's all sad.
there you have it. So, all right, enough on that page. Let's see, what's next? We're going to shift just a little bit here. This is not income tax. And sometimes people get confused with income tax versus estate tax. What this base amount is talking about, so in 2024, this number had increased based on the 2017 changes. In 2024, this number was 13.6 million. What that means is you could have an estate of $13.6 million and there would be no estate taxes, okay? In a married couple, this is doubled. So a married couple in 2024 could have an estate of $27.2 million and there would be no estate tax.
Upon death
Yes,
of both of you.
of both of you. So what the new law did is it just changed this exemption or you can call it an exclusion. I think the terminology is a credit, like they give you a credit against your state tax that basically just equates to these numbers we're talking about. So this is made permanent to $15 million for 2026. So a married couple, $30 million. And then this base of 15 million will be indexed for inflation, and so that will continue to increase. Depending on how long some of you have been around, for decades, this exclusion was $600,000. Meaning, at the time that that was the law, I mean, that started changing back in the 90s.
You guys have a paid off house, you would owe it.
Yes. So maybe not here at that time, but like...
Houses worth $600,000.
Well,
But we,
they are now.
but we had one of our tax partners that moved up from California, who was very experienced in estate taxes and all that stuff, because at that time in California, if you owned a house, you had an estate tax problem. That's all you needed was a house, and so at some point Congress wised up, and they saw that $600,000 that had been set, who knows how long ago, needed to be adjusted, because it wasn't intended the estate tax wasn't intended to apply to the general population. It was really intended to apply to ultra wealthy families that just had, well, now $30 million of assets. So this is a good thing. In general, it's good. I have an opinion about the estate tax that I don't know how or why the government thinks that they need your families.
It's not at all, right?
Yeah.
Amen.
I mean, my opinion probably doesn't matter, but that's, I guess, just my opinion. So,
Because they tax you crazy your whole life, and then you die, and then...
yeah. So one thing about this, because some people have talked about, well, why don't we just eliminate the estate tax? And that sounds like a great idea, but part of this that's not really mentioned here, that's always been in play, since I've been around for the last 30 years is what we call a step-up basis, stepped-up basis for inherited assets. So if you remember in 2010,
Was that the year to die?
yes,
Yes,
The-
I remember that.
the one guy in New York that owned the Yankees or whoever, is that who it was? He died in that year, so that was like great for him. But if you eliminate this estate tax exemption, one of the consequences of that is likely that they would eliminate the stepped-up basis rules, which means the capital gains that are stored up in your assets, say mom and dad buy an apartment building in the 80s, and now they're going to move on to the next stage of life by dying. Whatever their basis in that, which is going to just be kind of almost zero because they've depreciated it all out. Well, under the existing laws, when they pass away, that apartment building gets a stepped-up basis to the value at death. The heirs can either sell it for that and not pay any capital gains, or they can begin taking depreciation expense based on that value. So if they eliminate the estate tax, they would also eliminate that step up in basis, and that would be horrific for the heirs. It wouldn't matter to mom and dad because they're gone, but the heirs would then be stuck with a huge capital gain if they wanted to sell it. So this is one of those, like, I'm not necessarily a proponent of eliminating the estate tax, but I'm for increasing that amount as much as we can so that it really is only applying to like the Michael Jacksons of the world. The state and local income tax, this one's been talked about a lot. When we're talking amongst ourselves, accountants, we call this the SALT situation, state and local taxes. So you'll recall that one of the itemized deductions on an individual tax return is your property tax on your home and your state income tax that you pay. It's a deduction on your federal return. So in 2017, this was one of the changes in 2017 that was not necessarily a good thing for most taxpayers. Most of those changes and most of the changes in this new bill were in general good for the general normal taxpayers like us in this room. So this is one of the things that wasn't awesome. They capped this at $10,000, meaning even if you paid state income taxes of $15,000 and property taxes of $3,000, you could still only just deduct $10,000. So that really put a limit on some people, particularly in states that have high income taxes. Like this was something that really hurt people in California and New York. Those are the two I think of that just have really high state income taxes. And so this cap was, like everything else, set to expire, which if this part expired, it actually would have been kind of a good thing, but it didn't, and they didn't eliminate it. All they did was they increased the cap to $40,000. So that's going to allow a lot more people to take advantage of this deduction, but again, there's a segment of the wealthy population that live in a state that has income taxes that's still going to be a limitation for them. So this cap is quote unquote permanent, meaning we know when it's going to end. It is going to end. So it's not necessarily permanent, but we know it's in 2029, it's going to jump back to 10,000.
So in 2025, so starting in 2025, it'll be jumped up to 40,000, and then for 2025, 26, 27, 28, and 29, it'll be increased a little bit by 1% every year, and then starting in 2030, it'll go back down to 10,000 as a cap.
So you might ask yourself, well, why did they do this? Like, why did they make it go back? And it all has to do with the math that they have to go through in order to get a bill passed and to calculate the future revenue that the government's going to need to operate. And so that's what they did there. Again, this has an income threshold, so once your income gets above a certain amount, they also start eliminating that, phasing it out, we call it.
And that phase out will also increase by 1% every year, just to track it with the exemption or the cap. Yeah, so just going off of this, many of you have probably heard about this SALT deduction limitation when it was first come out with the TCJA. I call it TICJA, and the OBBB, I just call it OB. It's just, I don't know, easier for me to say. A lot of states noticed that this was a problem for a lot of their taxpayers, and so a lot of states came out with this pass-through entity tax availability. And what this essentially means is that if you own a flow-through entity, so a partnership or an S corporation, if you are either a shareholder or a partner in either of those two things, you have the ability to use what's called pass-through entity payments. And so your business tax return, so your partnership or your S corp, could actually pay your state taxes for you. You'll get a federal deduction on the business, and then you'll pick up the credit on the state. So it's in a way to round about this exemption or this cap. So let's say you were capped at 10,000, but you wanted to pay in 20,000 you have to pay 20,000 to the state, right? So if you're a partnership, the partnership can pay that 20,000 for you, and then you get to lower your federal income by that 20,000, and then you get that credit on the state. For Utah, and let's say we're in Utah because we are. On Utah, you would just increase your income. There's an adjustment on the tax return. You increase it by that 20,000, and then you get a credit for 20,000. And for Utah, if you don't use it up, you get to carry it forward for 5 years, and it's a non-refundable credit. So that was a workaround. Under the House passed OB, they did away with that SALT workaround, that pass-through entity payment workaround. The Senate brought it back, so it's not back. So we still have that availability for partnerships and S corporations, and so it's still something, even though it is now increased to 40,000, it might still be a good option for you, for businesses to use. I don't know if either of you have been using that already, and if not, you should look into it, especially for 2025 and years forward. So that's just kind of my little caveat to go us into now, like the business section. We're going to talk about the two main business provisions that pretty much apply to every single person who owns a business. There are other business provisions as well that was changed or enacted, but they're more of a niche subset of things that we can talk about under the honorable mentions if we have time. So the first one is 100% bonus depreciation has been restored, and then Section 199A, qualified business income, you might also hear it as QBI or QBIA or something along those lines. So first of all, 100% bonus depreciation is restored. So under the TCJA, they came out with the bonus depreciation at 100%. What does that mean? I guess we can go back to what does even depreciation mean. So when a business purchases an asset or even builds an asset, they have to capitalize it on their books, and then they expense it for the useful life, and the IRS determines what the useful life of that asset is. So for like furniture, it's 7 years. For computers, it's 5 years. Buildings like this, depending on if it's residential or non-residential, it could be 27 and a half or 39 or whatever. So with this depreciation 100% bonus under the TICJA, it was 100% for tax years 2018, 2019, 2020, and then it started phasing out by 20% every single year, and it was supposed to be completely phased out in 2027. And so bonus depreciation was going away. A lot of people liked bonus depreciation because businesses could purchase those capital assets, those assets that would normally have to be depreciated, and then be able to expense it fully in the year that they purchase it. It's just a way to accelerate your expenses. So as tax professionals, tax preparers, we like to accelerate expenses and defer income, legally, obviously. So just because $1 today is worth more than $1 tomorrow. So we'd rather recognize income later, because that income, $100,000 of income today, is going to be worth a lot more than $100,000 of income tomorrow, if that makes sense. So this 100% bonus depreciation being restored is really nice because now we can go back to fully expensing those capital assets. Whereas if we couldn't, then we would have to capitalize them and then deduct them over its useful life. It starts, I don't know if there's a date specifically on here, but bonus depreciation is restored for 2025, and it's for all assets placed into service January 20th, 2025. So from January 20th, 2025 onwards, if you've placed into service a capital asset, then that is available for bonus depreciation.
But you can't do it with things you already have required before then, it won't apply.
Correct, if it's before, like January, so if you purchased an asset in between January 1st, 2025 and January 19th of 2025, it's not under this 100% bonus depreciation rule. Why January 20th? I don't think there's like the government or the IRS hasn't said why necessarily, but we've kind of theorized that's when Donald Trump came into office. He was inaugurated on January 20th, and so he just, so that's pretty much, so since he's been in office, he restored 100% bonus depreciation. Without the OBB, the OB, it would have gone out, phased out completely in 2027. There is still Section 179, and that's outside of the scope of this. There were some changes with Section 179 as well in this bill, but since bonus depreciation is more beneficial, we decided to just talk about this instead. So
So the cost segregation studies and everything associated with accelerated depreciation in 179, that continues, bonus depreciation is separate from that.
Yeah, so for those who don't know what cost segregation is, so when you purchase or even build like a building like this, right? There's electrical, there's plumbing, there's furniture, there's flooring, all that stuff. All of that stuff in and of itself is not, we have real property and we have personal property and we have real property. Personal property, and if I'm getting too into the weeds, let me know. But if it's part of a building, normally has a longer useful life under the IRS rules. So a residential complex, apartment complex, useful life is 27 and a half years. And under IRS rules, you have to depreciate that over a straight line over those 27 and a half years. So it's kind of small in comparison, right, to what the total amount of the purchase price of the building is. Where if it's non-residential, it's 39 years. So you use a cost segregation study when you purchase, let's say we're using the residential like apartment building, you use a cost segregation to free up some of the assets so it's not labeled as real property or being part of the apartment complex. It's separated out so that we know the cost of all the furniture, all the electrical wiring, all the plumbing. And then that way you go from, let's say you purchase a residential building for $1 million. But let's say the plumbing, the electrical, the furniture, the furnishing, those sorts of things all come out to be $250,000. Now you can capture that $250,000 on a way shorter span than having to do it for over 27 and a half years. So it just breaks out the costs of you're segregating the costs of the building, right? Or the warehouse or whatever but normally it's for those kinds of assets. So bonus depreciation will allow you to, it still does not apply to buildings, real property. It applies to personal property. And essentially personal property just means property that you can like lift and move around, and it's just a little smaller, if that makes sense. So you can still accelerate that $250,000 if we're using the same example. Yeah, so it's this last bullet point. So introduction of a temporary 100% bonus depreciation for qualified production property. So what is qualified production property? So new to bonus depreciation under the OB and applicable to production property constructed after January 19th, 2025 and before January 1st, 2029. And it has to be placed into service before January 1st, 2031. So kind of a lot of jargon, but the construction needs to be done essentially finished before January 1st, 2029. What placed in service just means is that that's when you start using it, right? That's when it's available for use. So before January 1st, 2031, you are able to do that 100%, right? So it has to meet specified criteria. It's new non-residential real property. So real property, again, I talked about, it's pretty much buildings, right? Non-residential just means it's not for Yes, like apartments or condos or something like that, right? Non-residential just being like businesses being conducted at that space, right? It's constructed by the taxpayer. It is placed in service in the United States, and it is directly integral to a qualified production activity. So what does qualified production activity mean? It includes operation that involves substantial transformation of tangible property or like personal property, right? It includes manufacturing, production, agricultural, chemical production, refining with substantial transformation of qualified products. So that's kind of the incentive to bring manufacturing into the U.S. essentially. So they were able to do that. And then I don't know if anyone is familiar with something called depreciation recapture. It's not a term that is used very much just in the day-to-day talk of tax. But essentially, when you depreciate an asset, you're taking an ordinary deduction on that asset. And so when you sell it, you have your basis in your asset. Let's say it's $100,000. You bought an asset for $100,000, and then you fully depreciate it. So you've gotten $100,000 of ordinary expense. Now your basis is zero, right? Because you fully depreciated the building. If you sell it for $100,000, you have now $100,000 gain, even though you purchased it for $100,000 because you were able to take $100,000 of expenses. Depreciation recapture, when you think of if you're selling an asset, you're like, oh, it's a capital asset. Like I'm going to get capital gain on it. Well, you only get capital gain if you sell it more than what you've depreciated it. So for this $100,000, if you bought it for $100,000, fully depreciated it, sold it for $100,000, your depreciation recapture is $100,000, and that's actually ordinary gain. So it's not capital gain. And there's a difference between ordinary and capital. Ordinary is taxed at those income tax bracket rates, that 10, 12, yada yada rates. Capital gain is taxed at their own rates. They have different rates depending on what your income level is.
Is 20% still the highest that capital gains now?
20. So it depends on the capital asset. So it depends on what you're selling. So under here, when you see section 1250 property, that's real property. And if you have depreciation recapture on real property, that depreciation recapture is subject to capital gains rates of 25%. So in this case, it's 25%. However, they're changing it under the OB that it's subject to section 1245, which is changing it to ordinary rates. So normally if you have, and again, this might be getting into the weeds a little bit, but if you have real property and you sell it, any depreciation you've taken, you need to add that back as 25% tax rate, essentially. If you have regular property and you depreciate it, it's under section 1245, and it gets just classed as ordinary income. So long story short, it's just reclassing from 25% rate down to the ordinary income tax rate. So if your ordinary income tax is less than 25%, it's great. If it's more than 25%, then it's not so great. So, sorry, that was a lot. I apologize if I went too weeds. We can talk afterwards too if you have more questions.
I was going to say, we are at 1 o'clock, so.
Oh, my bad.
So we could.
I think this is the last.
This is the last one. And I'll just make it really short. Qualified business income deduction is just, in generality, 20% of your qualified business income, you get a deduction on your personal tax return. So flow-through entities like partnerships and S-corps, it's also available to your Schedule Cs as well on your personal tax return. It was set to go away after 2025. It was made permanent, and now it's at 20%. So there we go. Yeah, thank you. And yes, so we have honorable mentions, but we can talk about those later. We have a podcast, Tax Trails. You can find on Spotify, Apple Podcasts. it's on our YouTube channel as well. Yeah, we're here. If you guys have any questions, and if whoever needs to leave can head out.